Hello. Brilliant. Thank you, everyone. Hello. My name is Karen, and I'm with the marketing team for ESPC. You're here for the April property market update today. We've got Shirley, who's from ESPC Mortgages. We've got Wilson from Coulters and Ash from ESPC also, who's going to be giving us a generic property market update before we kick off. Thank you to everyone who has submitted questions in advance. We've done our best to try and condense these ones that are maybe similar, we've grouped together. But if you feel there's anything you would like us to expand on or other questions that you think we may have not covered, please just pop a question down in our Q&A box and we'll do our very best to get back to you before the end of the webinar. But I will let you know when we're coming up to our last couple of questions if you want to start popping them in there. But like I say, anything that we don't manage to get around to today, we can send you an email or follow up with you. So just please email myself at marketing@espc.com and I'll do my best to point you in the right direction and someone will be more than happy to help. At the end of this webinar, we do have a survey, so we're really hopeful that you would be able to fill that out just to kind of steer us in the right direction for how to make these webinars better for you in future. So we'd be really grateful if you could take 2 minutes to fill that out at the very end if possible. But to get us kicked off, let's start with Ash, who's going to give us our property market update.
Hi everyone, thank you so much, Karen. So yeah, just as Karen mentioned there, I'm just going to talk you through some of the kind of market updates we've seen over the last quarter, so looking at January through to March, and we'll do some comparisons year on year, and we'll just look at some of the data and what that means at the moment. So this is covering the areas of Edinburgh, Lothians, Fife and also the Borders. And just to confirm, it is averages, so if you're looking for any further information or want to find out a little bit more about a specific area, just get in touch with us and we can talk you through that data, and I'm sure Wilson will be more than happy to help you as well with that. So the first quarter of the year, we've witnessed some really interesting comparisons, I think it's safe to say, to the same time period we saw last year. And bear in mind, last year from January to March, the market was still impacted by a second national lockdown. So at the time, even though sales were permitted, the market moved at a slightly different pace. So we'll just bear that in mind when we are doing those year-on-year comparisons as well. So I think what we're starting to see for this quarter, and we're starting to see signs that the market is returning to pre-pandemic levels, and we're still seeing that trend of rising interest for those out-of-town properties. So we're seeing really strong buyer demand for homes outside the city centre that are slightly maybe more affordable. Places like West Lothian and also Mid Lothian are as well seem to be highly popular. We're still seeing really high demand for places like East Lothian and East Fife as well for that kind of coastal living. Those trends are still coming through there. And we're also seeing family homes in Edinburgh suburbs become increasingly popular as well. So I'll talk you through some of the data and some of the averages that we're seeing there. But the market activity is still really, really strong. You know, Wilson was just mentioning that before everyone came on there. We're still seeing it's a very strong market. Buyers are looking to secure their dream properties. Houses are selling extremely quickly and they're going above home report value in all these areas as well. But there is still a lot of affordable areas, and I'll talk you through a little bit of that to come. So first of all, I just thought we'd talk about some of the sales and listings that we're seeing through ESPC across Edinburgh, Lothians, Fife and the Borders for that time period of January through to March. So January to March last year, 2021, was probably a particularly, I can never say that word, frenzied, busy time for the housing market. So when we draw comparisons to this year, we can see activity returning to that kind of slightly, pre-pandemic level. So during that time frame this year, sales volumes across Edinburgh, Lothians, Fife and the Borders increased by 21.6%. A decrease, confirming more normal levels of activity. So we were down 21.6% in terms of sales volumes. Most sales volumes were found in areas like Leith and also Newington, and that seemed to be through things like two-bedroom flats. Two-bedroom flats in Newington were actually up 17%. year on year. When we have a look at insertions, so this is when properties are listed onto the market, the volume of new properties coming to the market increased ever so slightly by 2.1% year on year. Dunfermline had the highest volume of new properties coming on for sale, and also Trinity, where we saw new homes being listed up by 61%, which is incredible. We're heading into a traditionally busier time of the market, so hopefully we'll see that continue on and increase, and we see more properties come to market there. So when we're looking at average selling prices, the average selling property price across Edinburgh, Lothians, Fife and the Borders is currently sitting at £267,941, and that has risen by 3.3% year on year for that same time frame. We have saw significant increases in areas with high buyer demands, like West Lothian, as I was just mentioning, where the average selling price is actually jumped by 47% year on year. Mainly due to higher volume of properties selling, and also through East Fife, the average selling price is now £309,417, which again is up by 26%. But in contrast to that, we can see places like Dunfermline have actually dropped slightly. There's been a drop by about 6.1% in average selling price, and that's sitting at £182,173. And that's where we're seeing the most affordable properties come through at the moment, which is great if you're a first-time buyer or you're looking to buy in that area. So that seems to be really affordable. Edinburgh city centre, we didn't see any change in terms of average selling prices at that time frame, but we have seen really, really high demand for areas like Cammond, Barnton, Camo, and especially for 3-bed houses. These have been up by about 31% in terms of average selling prices, and that's sitting about £508,033. So I think it is just safe to say that all the different areas change, quite significantly from area to area. So these will all be averages. So if you do want to find out a little bit more, you can find it more in the house price report as well there. So with strong buyer demand also comes really quick selling times. So on average for Edinburgh, the Lothians, Fife and the Borders, properties are going to under offer in around 18 days from when they're listed, which is absolutely phenomenal. Homes sold particularly fast in areas like West Lothian and Mid Lothian as well. So we're looking at Edinburgh, the average time to under offer was 21 days. But some areas in the southwest were selling in only 13 days, which is not even 2 weeks, which is absolutely crazy. 1-bedroom flats in the city centre were going slightly slower in comparison to the year before, especially like areas like Abbey Hill and Meadowbank that are sitting at roughly 26 days to under offer, which is 6 days slower than it was at the same time frame last year. But I think we have to again take into account that the market last year from January to March we were still in a lockdown, so it just moved ever so slightly differently, but the average selling time is 18 days, and that again is just reconfirming that really strong buyer demand. In terms of buyer demand, again, when we're looking at percentage over home report value, so how much people are paying to secure their home over the home report, we're just seeing that rise in competition again, as we're seeing the property levels creep up slightly. Hopefully, as we see more coming on, that might level out. But from January to March, properties achieved on average 105.9% over home report value. So people were paying 5.9% on average for Edinburgh, Lothians, Fife and the Borders. So again, it's a kind of mosaic of different areas. And I think if you are looking to sell or you're looking to buy, it would definitely be worth speaking to Wilson. I'm sure we'll be able to help you from Coulters, just to really figure out what it is you would like to pay over and what homes are selling for. We saw 33% of homes listed actually went to a closing date, which also influences that pricing, so that when it goes to a closing date, people are more willing to pay above to make sure they try and secure something. Buyers paid the most in East Lothian and also East Fife, and the average for that was sitting about 107%. But again, different areas go for completely different amounts, so this is just averages completely. Edinburgh, so all the areas in Edinburgh saw an increase in terms of percentage paid above home report value, but especially in East Edinburgh. We saw the demand for 3-bedroom houses, and again, places like Crammond and Barnton going for up to 114% over, which again, a lot higher there, but it's still just showing that there's a lot of high buyer demand. So that is just a few key stats there. There is so much we could probably talk you through today. It's all on our house price report, which has just been published yesterday. You can find that on espc.com. But yeah, I mean, Wilson, I don't know if that's what you guys are seeing as well. That's just some kind of headline figures. Is that what you would say is happening out there?
Yeah, I would certainly agree. It certainly is a seller's market, and it's a tough market for buyers. So the data and the information provided, it certainly reflects what I'm seeing on the ground.
Good stuff. So yeah, I know that's a lot of information to take in. There's a lot of different data in there, but if you would like to find out any more, then just get in touch. But yeah, thanks, Karen. That's the property market update for now.
Thanks, Ash. Brilliant. Yeah, like I say, just get in touch. I know it can be a bit overwhelming to hear all the figures, but we're always here to help, and we try and break it down as much as possible on our house price report, which was just published yesterday, so it's really up to date. We'll move over to our Q&A now with Wilson and Shirley. The first question we've got here is for Wilson. Can we expect more houses to be listed in the springtime, or whether this shortage of houses is likely to continue?
Okay, so springtime is normally the time when the market picks up, and there's more properties that come to the market. It's really a seasonal market, so spring coming in from the winter period where people are starting to thinking to move, bring their houses to the market or flats to the market, and then move into summer, autumn, and then again slows down into kind of November, December. So it really is a seasonal market. So we can expect more properties to come to the market. You know, as was mentioned earlier, there has been a decrease in properties coming to the market. The volume is down by, I think it was 21%, it was mentioned earlier on. So not as much coming to the market as we would like, but certainly spring is the time for more properties coming to the market.
Brilliant. Thank you. Shirley, the next question is for yourself. I am self-employed and finding it difficult to navigate the mortgage process. Do you have any advice to someone who is self-employed?
Yeah, absolutely. I can fully appreciate this, and it is not easy at the moment. The first piece of advice would be get in touch with the ESPC Mortgages. We're more than happy to help you and guide you through this. And it is a minefield being self-employed and trying to get a mortgage even before COVID. Generally, lenders are looking for a 2-year track history, albeit there are some exceptions to this. If you are the owner of a limited company, you know, lenders take your income in different ways. Some will take salary and your share of the net profit. Some will take salary and dividend, but depends on whether they take it from the tax year end or your financial year end. So already you can see just how tricky you know, establishing, you know, which lender wants what and, you know, what they will take, so we can help you, guide you through that. Now, COVID has obviously made this situation even worse, with lenders nervous about how COVID may have impacted your business. And indeed, we are seeing some people with businesses that have been impacted by COVID. All lenders have reacted differently to this. Some have changed their criteria in the way in which they will take your income. Others have reduced the loan to value that they're prepared to offer. However, some have been more sympathetic and are actually saying, look, come to us and speak to us, and you know, we'll see what we can do. They've put COVID recovery plans in place, which is great. So we can help you, you know, guide you through what might be the best solution for you. Yeah.
Brilliant. Thank you, Shirley. And the next question's for Wilson. How can we secure a property with a bid before going to closing? If the property does go to closing, how do we know what bid to place to secure the property?
Very good question, and a very tough market for buyers. I would say where you see a property that you like, where you want to offer on it, generally what you'll find is there's other people wanting to offer on it too. There's a question later on about how much do I need to offer over to secure a property. I think ultimately you're going to have to be in a good financial position to present an offer to any seller to make sure that the property comes off the market before a closing date. Most estate agents, now I'm a solicitor, but most estate agents will be advising their clients on sales that if the property is popular with viewings and people downloading the home report, generally they would suggest driving it to a closing date, because at closing dates you generally get the best results. So any offer that you want to present to secure it, to bring it off the market before any closing date, would have to be a very good offer, especially in the current market. Of course, it depends from property to property. It depends from location to location. There is some still, and I would say it's a small amount, but there is some properties out there that are at fixed price. And it's normally first come, first served in those matters. But certainly to secure a property that potentially has got 2, 3, 5, 6, 10 notes of interest on it, you are looking at a significant offer over home report value to secure it. When it comes to offering at a closing date, take your solicitor's advice. It's maybe not what you want to hear. It's very difficult conversations with clients to say that you're going to have to offer X amount of home report value in the current market. So consider your solicitor's advice. Of course, you need to offer what's affordable to you. You need to offer what you can borrow on of lending if you're getting lending there. But certainly take your solicitor's advice in that, as well as your own instinct.
Thank you. And just to follow up, another question for yourself. How can I ensure I'm making the most out of advertising my property?
Well, with medium times to go on offer under offer 18 days or 21 days in Edinburgh, or less in other parts of, I think East Lothian was less, but maximising marketing on your property is really through your estate agents, and that will be through the portals that they upload the property to. So ESPC being the main one in Edinburgh, the leading one in Edinburgh, and then there's other portals. I don't think I'm allowed to say those on this conference call. But there are other portals that estate agents will use. And then there's the social media channels. I know Instagram and Facebook are used extensively. So making sure, I suppose at pre-market stage, when you're getting prospective estate agents out, making sure what services they offer and where they market the property, and is there anything alternative that they offer. Sometimes that comes with a price, sometimes it doesn't. So I would engage with your estate agent right at the start to make sure where the property is being marketed. But obviously there's ESPC and others if required, as well as the own estate agents' social media channels.
Thank you. The next question is for Shirley. So this time it's coming from a first-time buyer. I'm a first-time buyer, and how do lenders determine how much I can borrow?
Okay, so that is defined as what's called affordability, and there are a few factors in this. We sometimes hear sort of rules of thumb, 4.5 times in income and all those types. The best way to do this is, again, get in touch with us. It is very specific to your circumstances. The biggest factor that's going to the biggest factor in calculating, if I can spit my words out, affordability. The more you earn, quite simply, the more lenders are prepared to give you. Term, how long are you going to spread those mortgage payments over? And that will be a factor in affordability and calculating that out. The items that are going to impact your affordability, drive it back down, financial dependence. That means children. Those are expensive items, you know, and it's unfortunately going to reduce your affordability as well. Or any adults that are dependent on you. Again, you know, lenders will reduce your affordability, factoring how many people are dependent on you. Credit commitments, car finance, personal loans, credit cards, school fees, those types of things will all be taken into account in terms of affordability. And if you've got these items, there's potential to, again, reduce the amount that a lender is prepared to lend to you. And I suppose just on credit commitments, we see a lot of young people coming in having bought their car on PCP, first of all, and then, realizing it's having an impact on your affordability. So certainly be careful when you're taking out your PCPs or hire purchases. The other thing that lenders are becoming more wary of is credit card debt. So again, we hear people coming in thinking, oh, you know, I'll just pay that off before I draw down on my mortgage. And some lenders will not accept that. Some will still take it into account in terms of your affordability. And lately what we've been seeing is if a lender sees a pattern of credit card debt, they will count that in terms of affordability. So be careful with some of these things. Certainly, lenders like to see you having a bit of credit, but they don't want you to have too much, and that's when it does impact on your affordability.
Thank you. Wilson, the next question's for yourself. This person's in the Glasgow area and they're asking, what is the average percentage above home report value that houses are selling for there?
It varies, like in most areas. So in Edinburgh, it'll vary from kind of place to place, and Glasgow's no different. So West End, you're talking Hindland, Partick, Hillhead, the general West End area. It can be anything between 10 to 20% over the home report value. You go south of the river, you know, Shawlands can roughly be the same, but there's some areas, I suppose, in and around Glasgow, if you're looking at maybe Govan or further out afield, that you might get it for less. But I've recently offered in a few properties in Hamilton, and they're going potentially 10, 12, 15% over home report value. It depends on type of property as well. Flats are probably a little bit less, depending when you're looking to buy, a little bit less in terms of offers over. But again, housing, semi-detached, terraced houses, where they go to a closing date, you are looking at 15 to potentially 20%, or if not more, depending on the interest. So it varies from location to location and what style of property you're going for. But again, you know, if you are interested in a property, generally, I would advise you maybe not to consider the offers over and go straight to the home report value, because that's the starting point for your offers over, really. The offers over are more a marketing tool to get people interested in the property, and in the current market, everything is based on home report value. So from location to location, it will vary. Again, you know, you speak to your solicitor, or if you don't have one, please feel free to contact me, and certainly I can talk you through any advice on any particular property that you're interested in.
Thank
Actually,
you.
that's just on that, Wilson, that's quite an interesting point that you've made about home report value, because what we get a lot of, again, is people thinking that they can base their mortgage on purchase price, as opposed to home report value. And
it's something that I explain to, and mainly first-time buyers. So if you are a first-time buyer, you know, you can only borrow based on the home report value. So if you're getting a 95% mortgage, it will be based on the home report value. So anything that you pay over the home report value, that extra cash needs to come from somewhere. And generally, whilst you might have a great deposit, you might end up, if it was just buying a home report value, you could maybe get an 80% loan to value, but with what you've had to offer over, you might end up having a 95% loan to value. So always be very careful in terms of affordability. And again, speak to somebody like Shirley or myself in respect to that. But any borrowing you will get is solely on the home report value.
Yeah. Well said.
Brilliant. Thank you very much. The next question's for Wilson again. I live in Cyprus. I'm not a UK resident anymore. This person used to work in the UK. Am I allowed to buy a property, and what are the taxes and procedures as this person lives abroad?
So there's nothing stopping you from buying a property in the UK. I suppose in terms of what you might want to check if you're no longer a UK resident or you don't no longer hold a UK passport, what your rights of access are to the country. If you can come in and stay for 3 months, or do you require a visa? But certainly none of that will stop you buying a property. In terms of tax, if you own a property in Cyprus, you will be liable for second home tax in the UK, as well as the normal land and buildings transaction tax, or some, if you lived in UK previously, you might have known it as stamp duty. So you'll be liable for that at the point of purchase. Other things to consider would be if the property is going to be rented out. You need to think about declaring income tax to HMRC. And potentially when you go to sell the property on, if it's in numerous years and you've made a decent gain on it, you would have to pay capital gains if it's a second home as well. Big thing, what you might want to consider is depending how you're financing your purchase. If it's cash, then fine. But if it's lending, you might have a restricted market there in terms of mortgages. It would be more the international banks like HSBC and maybe NatWest who would only consider lending to you. To have access to the full financial market, i.e. mortgage market, you would need to live in the UK. So nothing stopping you buying a property. Taxes, LBTT and the second home tax on purchase, and think about income tax and capital gains when owning the property. And lending, you might want to think about how you're going to structure your purchase.
Yeah, there are certainly expat mortgages out there for buy to let, but those do come with a criteria, and a lot of them expect you to have a certain income and a credit history in the UK, and potentially another property. So yeah, again, you could always speak to us about that.
Brilliant. So this is the last question of our pre-submitted questions that we're coming on to now. So if anyone wants to add anything or ask some more questions before we finish up today, please do so now. But the last of the pre-submitted questions are for yourself, Shirley. How do lenders decide the interest rate that I can get?
Okay, that's quite a broad question. I'll try and cover off a few of the factors here. So obviously over the last few months we've seen an increase in the Bank of England base rate, trying to obviously get inflation under control. So that's obviously influenced the lenders' rates as well. It's not the only thing that influences lenders' rates, but it is a factor. The other thing is, type of lending. Is this for a residential mortgage? Is it a buy-to-let? Is it something more specialist like a limited company or buy-to-let or HMO, house of multiple occupancy? Those all vary in terms of their interest rate, and generally the more specialist you get, the higher the interest rates. Let's assume that we're talking about a residential mortgage. Loan to value is a big factor. The larger the deposit you put down, the less risk there is for a lender and the more favourable your rates are. So that's one of the biggest factors in loan to value. Product is also a factor. Is it a 2-year product? Is it a 5-year product? 2-year products generally have lower interest rates. However, lately we have seen 5-year products becoming very competitive, which is quite interesting with increasing interest rates. Fee, this is one to be careful of, and what we do at ESPC Mortgages is obviously analyse what a mortgage will cost you, including the fee. So sometimes lenders will try and tempt you in with a lowered interest rate, and people get attracted because of what looks like a low interest rate. However, including the lender's arrangement fee in with the analysis is an important thing to do, because you may well be better with a higher interest rate and no fee rather than a lower interest rate and a fee. Credit score is also important. If you have an impaired credit history, mainstream lenders may decide it's not for, your case isn't for them, and then we have to go down a specialist lender route, and that can mean higher interest rates, higher fees, more time consuming application process. The other thing that people maybe aren't quite as aware of is service levels. When a lender is busy, the way in which they control their work levels is actually to pull back from the market, and one of the controls they have is obviously increasing the interest rates on the products to make them less attractive at that point, so they can get the cases that they've got on their desk out the door, and then we'll see them becoming more competitive again. So what we sometimes see is where some lenders are incredibly busy, and you maybe get 2 or 3 of them at the same time. It obviously has an impact on the rest of the market. So everybody else goes, oh, we're really busy, we'll increase our interest rate too, and pull back a bit because we can't cope. So you get those sorts of roller coaster types of behaviours affecting interest rates as well.
Brilliant, thank you. So we've got a couple questions in. So Shirley, Wilson, Ash, feel free to just jump in with whoever would like to. The first question is, what premiums are expected in the East Lothian areas of Haddington and Dunbar?
I've just Wilson, I don't know if you can add into this, but I've just had a quick look. So just over the last 6 months. So first of all, for Haddington, it's looking, again, this is on average, so it will just vary from property to property, but you are looking at 110%, of home report value. So 10% roughly over the last 6 months. And also Dunbar's looking at 14% over. So 114% over home report value. I don't know if that's kind of what you would say, Wilson, as well, or I mean, again, it just varies the property, doesn't it?
I would say on average probably it's right, and that will be varied across a wide spectre of properties and a wide volume of prices paid. I think the way people have just got to look at it in terms of any area is, if they go to see a property and they think, wow, I like this, then generally somebody else is going to be saying the same thing. So it's about, I suppose, managing your own expectations. So if your affordability is at 200, 300, 400,000, you really need to look at the home report at the start and go, okay, home report's this. It's nice, it's lovely, we've seen it, it's popular, it's going to achieve X over the home report. And that X generally, if you're looking at 110%, you're looking at 114%. I've seen some properties in Haddington go a third over the home report value. I've seen some properties in, your Gullens, your North Berwick's easily go just under the third. So it depends on property, it depends on location. But if you're seeing a property, if you're thinking, wow, I really like this, somebody else is potentially doing the same thing. And if it goes to a closing date, then depending on the property and the amount of interest, you are anything between 10 and 20%, and sometimes over. It is a tough market for buyers.
Thank you. I've got another question here. This person says, we have lost out to cash buyers over the last 2 years that have no family or place to live to sell first, and the rental market is competitive and expensive. So they're asking, what do you recommend for buyers like us?
It sounds as if they've obviously had a tough run of it. You know, cash, whether you're in a popular, strong market or whether you're in a contracted market, is always going to be king, unfortunately. It takes out, you know, subject to mortgage, it takes out subject to sale, it takes out a lot of the risk that is involved in any sale and any purchase. I suppose, you know, if you keep missing out, the questions will be, how much are you missing out by? Do you need to, and I'm afraid to say this, maybe manage your own expectations of what you can buy and where you can buy? So maybe looking at different options, different areas. I know in a strong market, you could potentially be persuaded to go towards a new build. With new builds, you generally will get a fixed price from a builder. The difficulty with a new build is getting the date of entry and how long it will take to get into the property. But it is a tough market, and if you keep missing out to cash buyers, then it's unfortunately understandable. Sometimes at a closing date, you can be top of the tree, but there's a cash buyer just below you, and the sellers just want the certainty, and they can go for the second top offer. So yeah, cash is unfortunately still the strongest position to be in.
Thank you. We've got another question here. Do you think that the increasing interest rate environment, energy bills having just jumped up and expected to be hiked again in October, coupled with the very high inflation in general, could lead to a market slowdown this year? I know it's a bit of a difficult question.
I'll jump in, and then somebody can add to the back of that. I think, I hope that it doesn't create a slowdown, but I hope it kind of takes the edge off the pandemic market. And I think we're still at the back end of the pandemic market. People are still looking for space. People are still wanting, you know, the garden ground, the extra space, and they're still looking for that, still paying premiums, you know, as you've heard quite a lot over the home report value. So I hope that, unfortunately, you know, everybody's impacted by the inflation going up, and Bank of England are trying to control that through interest rates. So my hope is that it slows it down in the sense that we're not going into the 20% plus anymore. We're not doing 23, 24, 25% offers over. We maybe go back to pre-pandemic levels where it was still a strong market, but it was, you know, if you're paying 15 to 20%, it has to be an absolutely exceptional property. And a lot of the properties we're offering on at the 15 to 20% are nice properties, but they're not exceptional. So my hope is that it slows a little. But, you know, if I had a crystal ball and can see what was around the corner, I'd probably be making a lot of money out of it. So unfortunately, nobody can see what's around the corner. But yeah, I would say interest rates going up, cost of living in terms of inflation and how that's controlled is going to be key going into next year. But my hope is that it just brings it back to pre-pandemic kind of market environment where it's strong, but it's not in the realms of being crazy strong the way it is now, because it's not fundamentally sustainable.
Yeah, I would certainly agree with that, Wilson. Yeah, something akin to pre-pandemic levels would certainly be nice, and I think a more reasonable environment for everybody to be in.
And the other way you got to look at it as well is everybody's decided to move out of the city, and the figures kind of reflect that with, you know, because Edinburgh is becoming excuse me, Edinburgh is becoming unaffordable, and that's why you see West Lothian and Mid Lothian coming up in prices and going beyond home report values. You know, East Lothian has always been popular, and North Berwick, I think, a couple of years running, has been voted the most expensive seaside town in Scotland. So East Lothian and Edinburgh has always been popular. So the other areas that maybe haven't been on that radar, your West Lothians, where there's a lot of new builds happening, and Mid Lothian, where there's a lot of new builds happening, are slowly creeping up, or well, West Lothian has completely shot up. So, in a couple of years, people that have moved out of town maybe want to move back into town because, COVID is a thing of the past, hopefully. And, they might not like living further out of town, and that life might not be for them. So the market has the potential to change again. And it's changed, from lockdown, where there was a lot of concern about how the property market would react, and it's reacted by just getting stronger and stronger in certain markets. So the hope is that it tailors off a little bit and goes back to pre-pandemic levels. Because as I said, I don't think fundamentally to keep going the way we are is sustainable. And with interest rates going up, that will affect people's amount that they can borrow based on repayment.
Yeah, and certainly some of the lenders are reacting to that as well. You're absolutely right. We've seen some lenders adjusting their calculators that we talked about earlier to increase the cost of living. Lenders have a responsibility to their borrowers to make sure that they can afford it, and they aren't, likely to get themselves into trouble. And yeah, we've certainly seen lenders reacting to that cost of living too.
Thank you. This attendee is looking for optimism on the market. Very specifically, do you see more detached 1930s bungalows coming up for sale in Edinburgh over the next few months? Don't know if anyone has any insight into that.
The Edinburgh bungalow is always popular. And it can go a couple of ways generally. And don't want to be too dour about this, but generally when they come to the market, it's either somebody looking to downsize, i.e. somebody who's had a family and they've left home, or unfortunately somebody's passed away or somebody's went into care. They generally don't change hands that often, and when they do come on the market, they go very quickly. And they can go very quickly in numerous conditions, i.e. you need to spend quite a lot of money on them to do them up, or they've been extended and they're in walk-in condition, but they still sell. So I would say they do come to the market, and they're very popular, but they probably don't come to the market as much as people would want them to. Maybe it doesn't answer your question the way you want it answered, but they're a very popular style of purchase in Edinburgh.
Thank you. And the last question for today before we wrap up, what is the average percentage above home report for properties in the new town? And if a property has been on the market for over 6 weeks, does that ring any alarm bells?
Offers over in the new town will depend from property to property. I think the best way to be guided that is closing dates and notes of interest. If a property's been on 6 weeks, there could be numerous reasons why it's been on 6 weeks. It could just have fallen through the marketing gap. Sometimes it happens. Or there may be more specific issues with the property. It might just not be as attractive as some other properties. The layout might be weird. It might not suit people's living. There might be damp in the property. There might be structural issues with the property. So again, probably speaking to your solicitor on trying to understand why it's been on the market that long would be a good start, and trying to speak to the estate agent to understand why it's been in the property the market that long, and just asking the straightforward question. Why is it there? Why, given the market, has it not moved? Why is it not moved? And you'll get, hopefully, the story from that. But speak to your solicitor about the home report and whatever other information they can get from the estate agent. And if it's been on 6 weeks, and if there's no interest, then potentially there could be a deal to be done. Yeah. I mean, there are deals to be done on the market. They're just few and far between at the minute.
Yeah, certainly we sometimes see people that have come, you know, at a closing date, maybe it's gone to a closing date, someone's finance has fallen through and the property's come back onto the market. And that's certainly where we sometimes see clients becoming successful. The fact that they've just thrown their hat into the ring in terms of putting in an offer, you then have, you know, the seller coming back to them and saying, oh, actually, you know, this is the first placed purchaser has fallen through, and this is now an opportunity. But yeah, I think you have to be very careful about properties that have been on the market and making assumptions. I mean, because it could be for a variety of reasons, and it could be that first placed person, you know, at a closing date hasn't been able to get the finance. We see that a lot. We see it for a variety of different reasons as well. So worth checking out.
Brilliant. Thank you. And thank you everyone for submitting all those questions as well. Got some great discussions and hopefully answered all of your questions. But if there is anything you'd like us to expand on or ask us privately, please just email myself at marketing@espc.com and I'll pass you over to the relevant person. So of course, thank you everyone for joining us today. We really appreciate it. And of course, thank you to the fabulous panelists. We've really appreciated your insight and ability to just kind of answer all the questions, even if the other ones were a bit last minute and less prepared, compared to the others. That was fantastic. And thank you all again for coming. Do look out for our next webinar. It's the buy to let one in a couple of weeks' time, and then we have a first time buyers one at the end of April as well. And do not forget to fill out the survey. It really helps us. So thank you again, everyone. And